What's up, guys? It's Tyler again, coming at you today. Another video regarding the individual government loan types. Today we're going to talk about the USDA RD loan. So this is one a lot of lenders aren't extremely familiar with. A lot of people do it, but it's definitely not as much in the forefront as like an FHA or VA or conventional loan. Why? It's a little more complicated. It's a little more strict. It's a little more niche. So just less lenders are familiar with it. Again, especially if you work with someone that's, you're in the city or you're in a more populated, densely populated area, your local bank probably doesn't do it because it's not really something that works in the area. So USDA, the U.S. Department of Agriculture. So they do mortgages. Weird. So it's an RD loan, rural development, USDA RD loan. There's two, well, there's more than two, but there's two that you will run into. Most people are going to be going with a USDA guaranteed loan, which is the regular no down payment, average income, average credit, kind of, vanilla loan. There's also a direct loan, which, to make it simply, it's the Section 8 of mortgages, basically. So it's subsidized. They will adjust your payment according to essentially what you can afford, and they'll basically pay into your mortgage. But again, that's for very, very low income households. There's guidelines online, and we'll discuss that. But it's really for people that aren't making a ton of money. So the USDA guaranteed loan. This is really it's for first-time home buyers. Actually, they don't want to be owning other properties. They want it as a primary residence and really an only residence. There is ways that they'll let you, like FHA. If you have a situation where you had to move and you currently own a home, you're going to move more than, I believe the guideline is, I think it's 250 miles away off the top of my head, but don't quote me on that. So if you're moving a fair distance away from the house you already own, and you have a good reason, again, the lender will run through the situation with you and probably run it by underwriting. But so it is possible to have a second home, but USDA, the plan is to have it as a primary residence. You don't own any other properties. Actually, and they don't even want it to be any sort of multifamily or anything like that. And some will do manufactured properties, brand new ones. Most lenders will not, just because it's very risky and they depreciate. So most lenders will not touch manufactured homes with a USDA loan. So who qualifies for a USDA RD loan? It's really your moderate income, moderate credit. They do need you a little bit higher than an FHA loan. The debt-to-income ratios are a little bit more strict. Credit requirements, the score requirements aren't that more strict, but the actual underwriting and credit is more in depth. So you'll have a lot more issues if you're at a lower credit score. If you have a lower credit score with an FHA loan, it can be fairly cut and dry. If you have a lower credit score with a USDA loan, it can be a real pain. And we're going to discuss that in a later video, refer and manual underwriting versus automated underwriting. So that's kind of something to throw out to your lender. But a USDA loan is definitely going to be more limiting than some of the other programs as far as your price point, because it just has a lower debt-to-income ratio requirement. So keeps you, again, we were talking about FHA, where they maybe let you go up to 47% of your gross monthly income. USDA with an exceptional file, a really good accept file through the automated system, can go up to 34% of your gross monthly income. So again, a lot less as far as required payment. Again, it's a no down payment loan, which is the big selling point on it. So again, I mentioned moderate income. So there are income restrictions with the USDA. There's a thing online, I'll post it in the description, so you can see the USDA map and the USDA income calculations and area restrictions and county limits. So you will search by county and put in your household size, and there's some other deductions as a calculation that goes along with it. But most counties under 4 people in the household, you're looking somewhere between $75,000 and $80,000 for the household. Again, and that's just not the person on the loan. That is everyone in the house. So you got grandma living with you. You got a 20-year-old kid out of college that's working. living with you, those incomes can put you over the income limits and disqualify you for the USDA loan. So definitely something to keep in mind. Also, the area restrictions. So USDA is a rural development loan, like we said. So they want you to be outside the city. It's less densely populated areas. So the USDA website provides a map that you can use. What I typically do is I'll just put in the address or put in the borrower's current address, assuming they're buying right around where they live currently, and that'll kind of zoom you in and see where you're at. You can also just open up the map and zoom in. You know, if you know geography at all, you can kind of figure out the areas you're looking to be in and just kind of scroll in and zoom in. So it's color coded very basically. I mean, most of it just looks like a normal map, and around the ineligible areas has kind of an orange-brown, shading. So that'll show you which areas are not eligible. Again, if you're looking at specific addresses and you're kind of towing the line of what areas are and aren't eligible, put in the address, because it will zoom you right down and tell you if that address is eligible. So that, again, like we've been kind of going over, the USDA loan is fairly restrictive in a lot of ways. Again, income, area, credit, because it is a no down payment loan, it just is a little bit more restrictive as far as all the underwriting guidelines. But along with that, and one of the pluses is very low mortgage insurance. So they don't call it mortgage insurance, like FHA doesn't technically call it mortgage insurance. It's called a guarantee fee, but it's 0.35% of your loan amount compared to FHA's 0.85, so less than half the mortgage insurance every month than an FHA loan. And conventional loans are probably going to be somewhere in the middle of that. But really, if you can get it, if you are eligible for it, your credit's fine and your debt to income ratios are low enough, you're really not trying to stretch your dollar a lot, USDA is really one of the best loans to get into, just because of the low fees, the low mortgage insurance, keeps you at a lower payment, and the rates are still just as good as anything else, as any of the other government loans. And they're actually capped to a certain amount, 1% over the 90-day max rate, Fannie Mae max rate, which you can look up online. So right now they're like 5.25%. So again, you're doing a no down payment loan, getting a reasonable rate, paying fairly low mortgage insurance, but the restrictions are the income, the areas, the credit requirements, things like that. So let's talk about the credit a little bit. So 620 is really what the minimum possible requirement is for a USDA loan. That would be the minimum that I would want to get a borrower into underwriting. Really, you want to be higher. I mean, between a 620 and a 640 credit score is very restrictive. It's a manually underwritten loan. They're going to be very tight as far as debt to income ratio requirements. They need a certain amount of credit history. They need 2 lines of credit over 12 months. If not, they need additional alternative lines of credit, utility bills, rent, things like that. So those things can be very limiting for especially a young borrower that hasn't had time to build credit and doesn't have the best score, maybe has a few negative things. But USDA underwriting has gotten a lot more strict the last few years, especially at a lower credit score. So really shoot for a 640. Really 680 is a lot better, especially if you don't have a lot of savings. If you have a 640 to 680 but have 3, 4, 5, 6 months of savings in the bank, that can be very helpful. But one of the other things that can disqualify you is if you have actually a 20% down payment in savings. Again, the loan officer, if they have any history with this, they'll be pretty good at getting around it. But technically, if you have a 20% down payment in savings, you are not eligible for a USDA loan. They will say, hey, you can get a conventional loan, you have the money for it, so you're not eligible. But again, there's a lot of ways around that. And again, a good loan officer will be able to help you out in that sort of situation. So some of the other restrictions, like we said, no multifamilies. Really, you can't even have anything that is the possibility of being rented out. So if you buy a house that has a room above the garage that is furnished and has its own separate entrance and may even have a little kitchenette or something like that, that will probably be disqualified from a USDA loan. Again, a good loan officer will try to make things work, and a good realtor as well that knows the program will try to set it up in a way that the appraisal won't determine it to be a livable unit or anything like that. But again, what I've run into, you have a walkout basement, you have a bathroom down there, and you have a microwave and a sink. I've had appraisers say, hey, this is a livable unit. And again, I obviously would make that argument. But if there's a quote unquote livable unit or rentable unit besides the main house, USDA can disqualify that property. So that is something to really keep in mind, is anything that can be interred as something like that, you really want to try to stay away from. So to wrap things up, the USDA Guaranteed RD Loan is a no down payment, government backed by the USDA mortgage. Typically 30-year. Rates are pretty close to everything else. I mean, they may be a little higher, but they are capped again, and they can only go so high. So you're not going to be getting something ridiculous. It's going to be maybe a point higher than if you're doing like a 20% down loan. So fairly reasonable, but they are restrictive in a lot of ways. Like we talked about, area, income, credit, all disqualify you. The house being something that may have a rental unit can disqualify that. It needs to be move-in ready, like FHA and a lot of the other government loans. So a lot of hoops to jump through with it. But if you do qualify, and the area you're in qualifies, and you're not looking to really push the debt to income ratios and things like that, it can be a great loan to get into because of the low fees and all that. So I'm sure this spurred a lot of questions. Leave it in the comment section below. I'll try to get back to you and answer any other questions that have come up. Might even do a second video about this program, again regarding underwriting and things like that. So again, if this was helpful, if you want to hear more stuff like this in the future, hit the like button, subscribe. When we're making more videos like this down the road. And again, if you have any questions, leave them in the comment section below, and I'll get back to you as soon as I can. Thank you so much. You guys have a good day.